The big driver, as we've been saying for a while here, is T-bond yields, TNX, the 10-year Treasury yield. You can see how this is the S&P. Soon as TNX rates broke out, that's when our correction started. Makes it difficult to foresee a correction ending unless we start to get better action out of TNX. Yields are exhausted. They're in overbought territory, but there's not really huge indications that they've backed off. They didn't back off on Friday, even though stocks reversed. And if you look at a monthly chart, we've just broken out of a flag pattern and really don't have any kind of resistance till 5.3 or so, which is quite a ways higher. So we get further in problems with supply and demand situation in bonds, we get further problems with growth being strong, or we get further with or unemployment not going up. We get any of those kind of problems, or with inflation, this market is the most vulnerable, and it's the driver. So you really have to keep your eye on what's happening in TNX to be able to figure out what's going on in the other markets. We've talked about the huge supply and demand gap, and we'll talk about that more. Now, the other thing that's happened this month that is kind of surprising, and we talked about it some last month, was that now the yield curve has steepened past its 12-month MA. And this is normally the time period when you get an inverted yield curve and you steepen past the 12-month MA, that's normally the time period you really want to be watching for global slowdown in economic activity to develop. Usually it's not till the yield curve starts to steepen that recession starts to materialize more. So this is a warning sign. As I said, this is a different kind of steepening than you normally get. Normally you get the kind of steepening where the Fed is cutting short-term rates and they're dropping faster than long-term rates, allowing the yield curve to re-steepen. And that's in response usually to clear indications that growth is slowing. That's often when you have the biggest market declines, et cetera. This is a bear steepening, as we talked about last month. So this is where long rates are going up more than short rates to allow the yield curve to steepen. But steepening from inversion, even with a bear steepening, has happened in front of recessions since World War II. So you want to this is just another indication to watch for slowdown in global growth that could become more material ahead. We have, of course, the yield curve that's been inverted, and it usually predicts within 36 months a recession. We've got about 24 months or 18 months to go on that prediction. We've got the yield curve, the leading economic indicators, which we see here. And yes, the yield curve is a big component in leading economic indicators. So what Haver did here is they took out the yield curve from the leading economic indicators, and it's still projecting a recession within the next 24 months. So we have the yield curve, we have the yield curve steepening, we have the LEI, we have credit tightening. We have a lot of indications saying to kind of be really careful if growth starts to soften, that it could be more serious. Another thing I want to point out, and that a lot of people have been talking about, is normally when we have this big of a increase in yields, this big of a decline in bonds, stocks follow and start to play catch up. We really still have a big gap here that hasn't caught up yet. Doesn't mean it will immediately, but what it does mean is there's vulnerability if we do see further technical breakdown. And then the other thing I want to point out is that we have had enough credit tightening and a very steep rise in rates that if it remains, if Fed is projecting that, until September of 2024, they're going to keep rates where they are, or maybe raise them and keep them where they are after that hike, one or two hikes if that really is the case, it is extremely difficult to not see a really sharp credit contraction developing, because this is the small cap market, which is the most vulnerable to higher interest rates. You can see that basically they don't have the money to cover their interest payments with projected and current earnings. And they're going to need to roll over a lot of paper at higher rates. That's going to be a credit crunch, particularly for the companies that are nonprofit companies that aren't really making money. So we've got the setup. If we really do stay higher for longer, it is extremely difficult to not foresee further shocks in the credit market and further problems that would lead to recession. So we really want to keep an eye on that. The credit spreads that Chuck always talks about, want to keep an eye on that. You notice the junk debt that we've been short for a long time. It's been sitting there, starting to come down again. And so we really want to watch those spreads carefully. The other thing, that is important to understand is credit standards have been, with these higher interest rates and with the inverted yield curve that doesn't give banks an incentive to lend, credit standards have still been going up rather sharply. They're not quite to levels that typically lead to recession, but they're getting very close, and the degree of increase has been substantial. And that's happening at a time when commercial and industrial loans have made new all-time post-World War II highs, and consumer loans have made new all-time post-World War II highs, and the debt payments as a percentage of discretionary spending for households is at new highs. So think about all this. We got this pressure on rates, and everybody was loaded up on debts because for a long time they were practically giving it away. That kind of leads to a problem. The people that have to roll things over are going to be in trouble, particularly if rates stay up. So we really want to keep our eye out for problems that could materialize, shocks that could develop from higher rates, or from deterioration in technicals that tells us that the correction is turning into something more severe. Could still have a further rally before that happens. We could not have the recession for almost a year, but we're getting enough signs that you really want to be watching very closely for problems. And you want to understand that if we do get an attempt at a cyclical recovery, we got a lot of other things happening that could really shorten that. Nearly a third of Russell 2000 companies don't make money. And a lot of these companies have to be rolling over their debt. That's a very toxic combination. It's one of the reasons that we see the real relative weakness and relative strength in the small caps has made new bear market lows, partly for this reason. And we see micro caps even weaker than small caps breaking down. So we really want to watch small caps. They're really an important area. That's where most stocks are. So it's a real controller of breadth. And so if we continue to see deterioration in small caps, it's not going to end well for the broad market eventually. Okay, and that brings us to look at internals, which is still kind of a mess, but it's a downward bias mess, I would say, right? The orange is the demand index. Demand index is normally the leader in a new bull market. That's normally stronger than supply is weak. That has not been the case off the October lows. And in fact, we have broken below the October lows now in the demand index. That's a very negative picture for demand that should normally be leading on the upside if this was a complete cyclical bull market. We're just not seeing that. Supply has been falling. So supply, of course, is bearish when it rises, right? And supply has been falling off here. That's really responsible for the rally off the October lows, but that's not a really great impetus for a sustained bull market, seeing supply come off. And supply's picked back up. If we move back over the March, February highs in the supply index, that would be a very negative sign for the market. And you can see the spread index, which is the demand minus supply, has already broken below its March lows. And if it breaks below the October lows, that would be a very, very negative sign for the market. So we're kind of in an ugly range, but still have a downward bias that has yet to be relieved. We're watching for correction over indicators in case we're still in sort of a truncated bull move. So far, haven't gotten strong demand, gotten some sort of barely intermediate term quality oversold and some downside capitulation, but it's quite possible that we're either going to retest or make new lows first, and we'll look at some of the reasons why. Major internals are somewhat similar to our supply and demand. They're kind of a trading range mix, but with a downward bias. So first of all, remember that not a plurality of major internals broke above their Feb highs. Really, one did. the advanced decline line. The others didn't. Well, recently we've got a couple of these. We need 4 of them really to make a plurality majority, but 2 of them have already broken below their October lows. That's very, very negative. And so we want to really watch and see if we get a plurality of these breaking those lows that will turn us much more negative on the market and allow us to suggest that maybe we just had a big, long bear rally and the bear market is returning. We don't have that yet. We're in a no man's land where we could have a correction over, or we could break down further. What interest rates do are going to be very important, and what the market does from here is going to be really critical.